First, Shell released their first quarter results this morning, just 3 days after BP published a healthy profit for the 3 months to March. Now, today's figures are expected to be good for the big oil producer. Oil prices being around 35% higher in the first quarter of this year compared with a year earlier. Does that mean the companies are over the worst that we've heard from them? Well, let's talk to James Spencer, former chairman of the Association of UK Oil Independents, also spent 9 years at BP, now managing director of Portland Fuel, knows what he's talking about. James, how much of a easier situation is it now for the oil companies than it was when the oil price was at those lows?
Well, it's easier. There's not too much rocket science about this. If the oil price goes up, the oil companies tend to do a bit better, and if the oil prices go down, they tend to do a bit worse. So not too much analytical thought goes into that one. But, I mean, clearly they're not out of the woods. I mean, the bottom line is the price dipped to $25 a barrel in the last 24 months, kind of 2015. And in the first quarter of this year, it was around the 55 mark. So clearly things are a lot better, but they're nothing like as good as they were when, for the oil companies, that is, when the price was in excess of $100 a barrel.
Well, it did actually get up to $147 a barrel, James, I don't know, 5-6 years ago. And certain American brokers were talking it up to $200, which turned out to be a load of rubbish.
Yeah, well, JP Morgan famously said we were going to head for a super spike. That was when it was about $150 a barrel, just before the financial crisis. And of course, within about 4 months, it had gone down to 35. So.
What alarms me a little bit about these results, and it's good that they're making profits because that they pay dividends and we all benefit from that. But you summed it up and you said if the oil price goes up, they do well, and if it goes down, they do badly. Isn't that leaving things to chance a bit? I mean, it means that things are outside the control of the oil companies because they're just reliant all the time on the oil price.
Yeah, I think it was ever thus, Mickey. I mean, to be fair to BP and Shell and all of the oil companies, they have cut back on costs quite a lot over the last 12, 18 months because they've had to. They've canned a lot of projects which were kind of borderline projects in terms of profitability. They've gone back to really focusing on those predominantly mature fields that still give them a decent yield and give them decent profit. But, if you look over the last 2 or 3 weeks, the oil price has actually been trailing off, and all eyes are really on May the 25th for the next OPEC meeting. But oil prices are now at $50 a barrel, having been in the last month 57, and there's a lot of bearish sentiment out there. That's going to maybe take prices down to 45, and suddenly the prognosis for the oil companies not so very good. So this is probably good timing for the oil companies that they're able to report on good Q1 results. I think if the oil price sits around 45 for the next quarter, then they'll be back to maybe not losing money, but certainly breaking even on the upstream element.
If you were an oil worker who's lost your job when the oil price was low, and we heard from all these big companies that they were laying off tens of thousands of staff, might you be sitting there thinking now, hearing this good news, now the price of a barrel of oil is back around $50, that maybe those companies went a little bit too far in the number of layoffs they made?
Well, as someone who used to be an oil worker a long time ago, I think I'd be probably heading to the gas sector. If there's a future for these oil companies, I mean, I suspect that in 10 years we may not be calling them oil majors, we'll be calling them oil and gas majors or even gas majors. I don't think the oil companies had any choice but to lay off people. I mean, fundamentally, the price was too low to sustain the number of people they had working on upstream projects. But a lot of these, certainly Total, Shell, and BP, ExxonMobil to a certain extent, they're all looking at gas as where they're going to spend, their big investment money is going to be gas. I suspect that's where the real interesting market will be.
Do you think that will take the sting out of the cost base? Because, you're faced with a situation that oil companies are now looking further and further afield for oil reserves in more and more difficult terrain, which means that the cost goes up all the time.
Absolutely, Mickey. And the bottom line is that a lot of these exploration plays that are further and further afield require a higher and higher price. And, it's no coincidence Shell pulled out of exploration in the Arctic because it was too expensive. And I don't think they're going to go back there because it remains too expensive versus the kind of expected norm for oil prices. And I think the problem that the oil companies have is that they've evaluated themselves and the market has evaluated them on the size of their reserves. But if those reserves are in very difficult to access places with high exploration costs, those reserves are increasingly worthless because they're never going to come out the ground.
Just before we go, James, what do you reckon from Shell, 7 o'clock this morning?
I think there'll be good results. I think there'll be an increase in results, but then the starting point was quite low. They weren't making very much profit 12 months ago, so it was arguably the bar was low.
James, thank you very much. James Spencer there from Portland Fuel.